Our daily reading
It's a daily devotional.
from Bitcoin 1 million. We've covered, what have we covered so far? We've covered
6 chapters. So we've done the power law,
Yeah.
money printer, inflation, stocks, bonds, real estate. So in 6 chapters.
and now we do
Chapter
gold
7.
on a day where gold is down 5%. And a fitting descent. Max Kaiser today said that Peter Schiff takes baths in the sewers of Puerto Rico. So
he would know because he lives there, or he did live there, I guess,
did?
until he moved to San Salvador, I guess.
Okay, yeah.
All
right, so why don't you start us off with gold?
Start us.
Okay, gold.
This is your story in the beginning.
This chapter explains why gold's 5,000-year monetary reign is ending. As a former gold bug who owns kilo bars, I will show you why Bitcoin beats gold on every metric that matters: scarcity, portability, divisibility, and verifiability. You'll understand why central banks keep buying gold. The central banks buying gold today are making the same mistake as Kodak, ignoring digital cameras. From gold bug to Bitcoin maxi. I'm a former gold bug, and that gives me a unique perspective on what's happening in the monetary world today. For decades, I was deeply invested in physical gold, buying kilobars at $300 an ounce, hard to believe, but true, investing in gold mines and trading the GLD ETF from day one in 2004. Gold wasn't just an investment, it was a central part of my portfolio and my worldview. Today, I don't touch it, and understanding why requires looking at both sides of this historic transition. I still understand gold investors because I was one of them. Working with Jim Rickards at Greenwich Capital taught me to see the monetary system's flaw. He's a brilliant guy. You've probably seen him on CNBC. And we still agree on the fundamental problems. The Fed is indeed a problem. Inflation is systematically understated, and government statistics are theater designed to maintain confidence in a failing system. What's fascinating is that gold bugs and Bitcoiners see exactly the same problems in our monetary system. We've just chosen different solutions to address them. Gold investors place their trust in physical metal stored in vaults, while Bitcoin investors trust the numbers and code. Where gold bugs count their wealth in ounces, Bitcoin counts theirs in sats. One group has chosen to preserve the past, the other is actively building the future. The numbers tell the story. Even Bitcoin priced in gold, removing dollar debasement from the equation, follows a power law with R squared equals 0.95, nearly as strong as Bitcoin priced in dollars. This data indicates that Bitcoin's performance relative to gold reflects more than just dollar weakness, revealing fundamental differences in their monetary properties. This relationship demonstrates Bitcoin adoption as a new monetary technology. Gold's historical role as a store of value faces challenges from systematically defined alternatives like Bitcoin. Here's the graph, the power law of Bitcoin relative to gold. And you can see it looks very much like the power law of Bitcoin relative to dollar, even though gold's done, a bunch of different things over the last 15 years. The correlation is very, very strong, almost the same as the correlation of Bitcoin to the dollar to time on a log scale. So, you want to continue, Ben?
Yeah, I'm just sharing this live stream
Okay.
with some people.
Great.
Cool. I like to let my people know that we're reading. People are enjoying the readings. If you're enjoying the readings, share them, like them, comment, send us a question. All that helps to more people too.
Yeah, we have more chapters to go, so
we're only a third of the way through the book, and
Right.
so we're sort of in the assets section now. We think of the book as being in 7 sections essentially. So we're in the second section,
right.
really. Gold's mythology versus Bitcoin's math. Gold and Bitcoin differ in their foundational properties. This is where you left off.
Right.
Gold's value derives from historical precedent and cultural significance, while Bitcoin's to Bitcoins derives from fixed scarcity. For 5,000 years, gold has captured the human imagination, not primarily because of its utility, but because of how it glows and what it represents. Entire empires rose and fell in pursuit of it. Kings hoarded it in their treasuries, and pirates died trying to steal it. This emotional and historical weight has given gold its monetary premium for millennia. However, gold's role in modern financial systems has evolved from its historical monetary function. It's still discussed in investment circles, it's still held by central banks, but it's no longer essential to how money actually works. Despite gold's reduced monetary role, it maintains a substantial market capitalization of 24 trillion.
A little bit higher.
No, it's a
now.
little bit higher now, yeah. That's over 10 times Bitcoin's 2.4 trillion market cap, which tells you something important. There's an enormous amount of wealth stuck in the past, waiting for the right catalyst to move it into the future. I'm not here to mock gold or diminish its historical importance. 5,000 years is an impressive run for any monetary technology, but that run is ending. And understanding why requires looking at how the world has fundamentally changed. Gold is an emotional asset. If you chart gold's price against its supply growth, you'd expect to find a rational relationship between the two. I did, and I was wrong. And that disconnect shows something important about gold's role in modern markets. The chart reveals the fundamental difference between gold and Bitcoin as monetary assets. Over decades of money printing, gold has maintained its value against the dollar, rising roughly in line with monetary expansion. But the relationship is chaotic and unpredictable. Gold's price movement appears almost unrelated to M2 money supply growth, fluctuating based on sentiment, geopolitical events, and market psychology rather than following any algorithmic law.
Let's look at this.
Let's look at the chart. It's pretty amazing.
Yeah, this chart is really interesting. So this chart
This
is,
shows the money. We'll put it in front of your face so it focuses.
Okay,
on
there we
it.
go. This is gold. Oh, I see it. The problem is I do it and the damn thing changes. Here it is, gold relative to money supply. And as you can see, it's a little bit all over the place. It doesn't completely track M2 money supply growth.
Right.
Okay.
So if it tracked it in this chart, because it's an index,
It's more or less constant, right? It's more or less a constant. But
this is, it's kind of a funny chart, but you would, if it was tracking it perfectly, you'd expect it to be
flat line.
a flat line going across the chart, right? So if you can look up other charts of this that also show you how, money printing is going up. Money printing goes up very quickly. And this line is chaotic. Sometimes it's going up really high when the money printer is not going up very much. Sometimes it goes down when the money printer's on. So it's completely uncorrelated to money printing is the idea. So if there was a strong correlation here, we'd see a straight line. Instead, we see this crazy line, right? It's a good way of thinking about it. Bitcoin's relationship, so it doesn't follow any algorithmic laws, what we said. Bitcoin's relationship to M2, by contrast, follows a precise power law with extraordinary correlation. Now, this was one of the questions my dad had, who came to Bitcoin Alpha last week, and they thought it was Peter Schiff. They thought that my dad looked
Your
like...
dad looks a lot like Peter
He looks
Schiff.
a lot like Peter Schiff, honestly. I see the
Same
resemblance.
general age.
Yeah, kind of, they're both really into gold, too. Or,
Yeah.
My dad still probably has some, but... But Bitcoin is extremely correlated to M2. Now, it's not a coincidence. It's Bitcoin capturing value as fiat money supply expands. So while gold stumbles around randomly, like the chart we showed you, Bitcoin rises with precision, making it the superior hedge against monetary debasement. Gold behaves less like a monetary asset and more like an emotional barometer, a mood ring for global anxiety. When war breaks out, gold might spike dramatically, or it might barely move. When inflation surges, gold sometimes rallies strongly, but just as often sits there doing nothing. During market crashes, gold occasionally soars as a safe haven, but other times it falls along with everything else. So there's no consistent logic and there's no reliable connection to any fundamentals. There's no link to productivity or economic growth at all. This is not a story. You can look up these charts. They're amazing to see. Gold's price movements often correlate with geopolitical uncertainty and market sentiment rather than fundamental economic factors. So when you examine gold's actual utility, the disconnect between its price and usefulness becomes even more stark. Yes, gold has some industrial applications, electronics, dentistry. There's some. Do you have any gold teeth? Jewelry, particularly in India and China. But this industrial demand is tiny compared to gold's $24 trillion market cap. The vast majority of gold's value comes not from what it can do, but from what people believe about it. And this belief rests on three pillars: that gold is scarce, timeless, and safe. However, each of these assumptions faces challenges when examined closely.
All right, let me go here. The utility and scarcity myth. The scarcity argument faces a fundamental problem. We don't actually know how much gold exists. Our estimates of above ground gold are just that, estimates. Below ground, we're just guessing. New mines open regularly, extraction techniques continuously improve, and old jewelry gets melted down and recycled. The supply picture is murky at best. Then there's the asteroid problem that gold bugs don't like to discuss. A single asteroid, 16 Psyche, contains enough gold to crash every market on Earth if we could mine it. While space-based mining remains speculative, advancing technology continues to expand resource extraction possibilities. The contrast with Bitcoin is significant. Bitcoin's supply is algorithmically determined and immutable. There's no printing, there's no discovering, there's no faking. The supply schedule is coded, public, and permanent. Everyone can verify it and no one can change it. Compared to Bitcoin's systematic scarcity, gold supply remains subject to discovery and extraction variables. Gold isn't money anymore. Using gold in commercial transactions requires additional verification and logistical considerations. Walk into any store and attempt to pay with gold, and you'll immediately hear the fundamental problem. How do I know it's real? This question highlights a key challenge in using gold as a medium of exchange in modern commerce. Every gold transaction requires an assay, a test, an expert with specialized equipment. You need third parties for verification, custody solutions for storage, and you're constantly exposed to counterpart risk. The friction is enormous, which is why almost no one actually transacts in physical gold anymore. Bitcoin solves this elegantly. Anyone, anywhere in the world, can verify Bitcoin by running a node and checking the blockchain through pure algorithm. This makes Bitcoin the first asset in human history that can be verified instantly by anyone with an internet connection, without experts, specialized equipment, or trusted third parties. This represents the characteristics needed for money in the digital economy. Gold, by comparison, requires physical infrastructure for verification and transfer. You want to go?
Yeah, Peter Schiff, reluctant prophet. We need to talk about Peter Schiff because his role in Bitcoin's adoption story is both ironic and instructive. For decades, Schiff has been preaching important truths about our monetary system, the dangers of fiat, the reality of inflation, government overreach, and how central banks are systematically destroying savings. Now, on these fundamental issues, he's absolutely right. And his analysis is often brilliant. While Schiff accurately describes monetary system problems, he advocates for gold rather than digital alternatives. He hates Bitcoin with a passion, won't touch it, won't endorse it, and spends considerable energy attacking it. Yet ironically, this has made him one of Bitcoin's best inadvertent salesmen. Thousands of current Bitcoiners started as Schiff followers, maybe even Satoshi himself. They heard his compelling message about monetary debasement, understood the severity of the problem, and then came to realize that gold wasn't the answer for the digital age. By highlighting monetary problems while dismissing Bitcoin, Schiff may have inadvertently led some followers to discover Bitcoin as an alternative to both fiat currency and gold. Performance gap between two assets. But the real wake-up call comes when you look at the broader performance numbers. Since President Nixon closed the gold window in 1971, ending the Bretton Woods system, Gold has risen from $35 to $3,600 today. Actually higher now. That's about 103x over 54 years, or roughly 8.9% annually. Respectable, but hardly spectacular when you consider the monetary debasement that drove it. Now consider Bitcoin. From its first recorded price of approximately 1 penny in 2010 to $120,000 in 2025, Bitcoin has delivered a 12 million x return over 15 years. Even if we start from Bitcoin's first real exchange rate of $1 in 2011, that's still 120,000% or X in 14 years. Let's be more fair to gold. Let's compare gold's best 15-year performance against Bitcoin's entire 15-year existence. Gold's best modern run from 1971 to 1980 delivered about 24x in 9 years. Bitcoin's performance has consistently exceeded gold's best historical periods.
Yeah, so let's just get a double click. Gold, since 1971, has 100x. Bitcoin has 1,000,000x. What do you want? 100x performance or
12
1
million
million
X, actually.
Even 12 million, but it's 1,000,000x since 2011. But even in sort of modern times, it's well over 1,000x,
Yeah.
right? So it really has massively overperformed gold.
Right. There's no debating it. Now, in real terms, gold peaked in 1980 and didn't surpass that level again until 2008. Bitcoin's trend remains relentlessly upward despite periodic drawdowns. Gold purchased at 1980 peak has delivered roughly 3.3% annually. The same investment in Bitcoin before 2016 would have created millionaire level wealth. The data shows Bitcoin and gold operating in different growth trajectories. Now ask yourself, will gold double in the next year, in the next 5? What would that require? A complete collapse of the dollar, maybe? A global war? A return to the gold standard? Now ask yourself the same about Bitcoin. Bitcoin doubling requires adoption, infrastructure, and institutional recognition, all of which are happening in real time. Bitcoin is still early, still misunderstood, still climbing the S curve of adoption. Its volatility is not a bug. It's a feature of power law growth. Gold, by contrast, is saturated. The story is old. The user base is aging. The momentum is flat. And these assets represent different phases of monetary evolution.
All right, so the generational divide.
This is great.
The generational divide between gold and Bitcoin investors tells you everything about where monetary value is heading. Go to a Bitcoin conference and you'll see the average age is about 35. Attend a gold conference and it's closer to 65. This demographic split shows the future systematically replacing the past. Millennials don't buy gold, and Gen Z doesn't even think about it. To them, gold occupies the same mental space as fax machines or checkbooks, obsolete technology that their grandparents used. Their entire digital life lived experience shapes this perspective, not any misunderstanding of money or value. They conduct financial transactions digitally. They work across borders remotely and value digital assets. For those whose economic activity is primarily digital, physical storage of wealth may seem less relevant. When gold bugs claim that young people don't understand real assets, they're revealing their own misunderstandings of how the world has changed. The younger generation understands perfectly. They've simply recognized the future is digital. Consider the practical reality of inheritance in both worlds. When grandpa leaves you gold bars, you inherit a logistical nightmare. Safety deposit boxes, insurance policies, assay requirements, transportation challenges, customs declarations, and endless storage fees. But when grandpa leaves you Bitcoin, does your grandpa leave you any Bitcoin?
No.
No. Okay.
My father actually at the event was
Yeah.
talking to some guy, and he's like, "Yeah, it's my granddaughter." Because my daughter was there running around. I have like a stock portfolio for her, and he was like, "Can I ask you a question? Why aren't you leaving her Bitcoin instead?" And he was like, wow, I really need to consider that. Now he's like talking to his
Oh, yeah, go.
advisors and stuff about it. So it's so funny.
But when Grandpa leaves you Bitcoin, the entire transfer consists of 12 words that grant you access to value anywhere on Earth, with no fees, no paperwork, no borders to cross. The wealth transfer is already happening on a massive scale. As baby boomers pass away and their children inherit, the first question isn't how to store the gold, it's how to convert it to Bitcoin. This represents the natural evolution of money in the digital world, not rebellion against tradition. Young people today build entire careers on intangible assets. Instagram followers that generate revenue, GitHub repositories that showcase their skills, LinkedIn networks that create opportunities. Physical ownership means nothing to them because their most valuable assets have been digital. Picture a 25-year-old software developer earning $200,000 while working from a Lisbon cafe. That person does not want gold bars that would anchor them to a specific location and require constant physical security. They want assets that move at internet speed, cross borders instantly, and grow faster than their already impressive salary. Gold represents analog wealth in an increasingly digital world, and that disconnect grows wider every day. The fundamental difference lies in how each generation perceives security. Older generations equate physical possession with safety. If you can hold it, if you can own it, then you can trust it. But younger generations see physical possession as risk. Physical assets can be stolen, damaged, or confiscated, and they tie you to specific locations and jurisdictions. Digital natives want their wealth stored in the logic rather than the metal, in code rather than in vaults, because they've seen too many examples of physical security failing while cryptographic security holds firm. The demographic tsunami is unstoppable. Every year brings more retirees from the gold holding generation and more earners from the Bitcoin native generation. Each inheritance cycle accelerates the transition from metal to the data, from analog to digital wealth. The direction is clear, the momentum is building, and the outcome is inevitable. So to me, this demographic argument is one of the strongest things. It's really what convinced me to be a Bitcoiner, because I really love the idea of that each demographic group has their own way of thinking of the world, right? And their own desires. Like millennials don't want McMansions, and they also don't want gold. They really do not want gold. I mean, I don't know. We could ask Argo.
Does anyone you know will have gold?
No.
Yeah. So we asked a millennial, no gold.
But it's kind of like that. Like our grandparents weren't into the stock market.
They weren't.
They weren't.
But they didn't trust it.
The stock market was viewed as a very speculative investment.
Right.
So corporate banks versus corporate treasuries. You want to read this one, or you want me to do it?
Go ahead. Why don't you read that one?
The divergence between what governments and corporations are choosing as reserve assets reveals a fascinating split in how different institutions see the future. Central banks have been buying gold at a frantic pace, over 1,000 tons each year since 2022. Poland, Turkey, India, China are all aggressively stacking gold, and it recently surpassed the euro to become the world's second largest reserve asset.
I think it might actually be the first.
It might be number one now. We should check. Their motivation is clear. They're trying to de-dollarize, seeking something America can't control through sanctions or monetary policy or tariffs. Meanwhile, look at what forward-thinking corporations and younger nations are doing. MicroStrategy holds 630,000 Bitcoin. Tesla put Bitcoin on its balance sheet. Square did the same. El Salvador made Bitcoin legal tender. The pattern is unmistakable. Governments, slow, bureaucratic, backward-looking, choose gold, while corporations, fast, competitive, forward-looking, choose Bitcoin. The split almost perfectly captures the difference between institutions preparing for the last war versus those positioning for the next one. Central banks are fighting yesterday's battles, preparing for the return of gold standards that will never materialize, while corporations are building for a digital, borderless future that's already arriving.
I mean, you don't want to be the French before World War II. They built this Maginot Line,
Right.
which was going to be the impenetrable fortress that was going to stop the Germans from coming in to France. Unfortunately, they didn't build it through Belgium. And the Germans said, we got these really fast Panzer tanks now. We're just going to cruise right up into Belgium and then right back down to France. So gold is the Maginot Line. It's stupid, okay?
Have you sold all yours yet? Or?
I need to.
You need
I
to.
honestly need to
This
do
is a
it.
good time because gold's already peaked.
I have a buyer who's a jeweler.
Oh, yeah. Awesome.
He wants.
Really? You have to send it to them? Or?
Yeah, he's going to come and get it. He's
Really?
going to send a courier, and I'm going to give him my gold. And he says, I said, I want this thing in Bitcoin. And he's like, no problem.
No problem.
No problem. I get you the big. They want the gold. They're having problems getting these bars of gold.
Yeah.
Anyways,
Because the bars themselves might fetch a little bit of a premium.
it's not going to go at a discount. I'll tell you that.
Oh, wow. Okay. Super cool. There's a notable disconnect. There's a notable disconnect between government and citizen preferences. This is where I was.
Yeah. Mm-hmm.
With central banks accumulating gold while many individuals increasingly choose digital assets. Consider what happened to Russia when it was sanctioned and cut off from SWIFT. Excuse me. Did their massive gold reserves help them conduct international trade? Not at all. They turned to cryptocurrency out of necessity. When China needs to trade with Iran despite sanctions, they don't ship gold bars across borders. They settle in Bitcoin. Gold proponents love to claim that their assets exist outside the system. But the practical reality tells a different story. You can't email gold to settle a transaction. You can't complete a transfer in 10 minutes, and you certainly can't hide large gold movements from surveillance. Bitcoin accomplishes all three effortlessly, which is why it's becoming the actual choice for transactions that need to exist outside traditional financial rails. Now, we're not trying to say that an advantage of Bitcoin is in a positive way is evading these rails by any means, but it's just a reality of Bitcoin. So the real question is what happens when this divergence becomes impossible to ignore. If corporate Bitcoin strategies significantly outperform traditional government reserve management, this may influence future policy decisions. As younger finance ministers who grew up understanding Bitcoin begin taking positions of power, the institutional reserve will start to crumble from within. We're already seeing early signs of this transition. El Salvador's Bitcoin holdings have become profitable. Corporate Bitcoin treasuries are destroying traditional portfolio returns. And young central bankers around the world are quietly studying Bitcoin's implications for its monetary policy. Now, I will say, when I met with the central banker of Panama, he was a 32 or 35-year-old guy at the time, young guy. And he already understood a bunch about Bitcoin. He was already thinking about Bitcoin. Of course, they're a dollarized economy. They have no local currency at all, like El Salvador. So they're very interested in what systems exist that would help protect them from dollar debasement, because they have no say in dollar debasement, and it affects their everything, their tourism, their production. It's really amazing. They didn't say they were interested, but they're interested. Of course, it's logical. So central banks may eventually reconsider their reserve compositions based on performance comparisons and changing monetary landscapes. When every major corporation holds Bitcoin on its balance sheet and the performance gap becomes undeniable, governments won't be able to justify hoarding what will increasingly look like shiny rocks, while the rest of the world builds wealth with the numbers. Shiny rocks is so funny. Institutional adoption may follow a gradual pattern that accelerates once certain thresholds are reached.
All right. Why gold bugs miss Bitcoin? The reason smart people miss Bitcoin isn't intellectual, it's psychological. Understanding this helps explain why brilliant investors and economists can completely miss the biggest monetary revolution in human history. Gold bugs have a deep psychological need to physically touch their wealth. To them, Bitcoin being pure information feels like buying air or modern art. They formed their worldview in an era before the internet, where physical possession meant real ownership, and you could only trust what you could hold in your hands. This perspective, while not wrong, has become outdated. Younger generations often feel more comfortable with analytic verification than physical custody. They've seen too many institutional failures to believe that physical possession means security. Both groups seek protection from monetary debasement. Gold advocates worry about Bitcoin's digital vulnerabilities, while Bitcoin's advocates point to gold's history of government confiscation. What gold bugs miss is that Bitcoin offers something gold never had: absolute scarcity, not physical scarcity that depends on mining technology and asteroid discoveries, but absolute scarcity that's absolute and verifiable.
Yeah.
Gold bugs also face a brutal coordination problem. Even if gold was objectively better, which it isn't, if the world chooses Bitcoin as the monetary standard, gold loses anyways. Most gold bugs won't make the switch. They're too invested, both financially and psychologically. But their kids will, and that generational transition is already underway.
Go ahead.
Okay, the mathematical crossover. So this is important. People are always,
Yeah.
well, gold's up 10 times as much as Bitcoin. Bitcoin's going to go up 10x, so it's going to cross over in like 2030 or something like that. But it won't, because gold's also going to increase. So the crossover is a little later. The data allows us to project when this transition reaches its inevitable conclusion. We can calculate when Bitcoin will surpass gold in market capitalization. Bitcoin has been growing at approximately 42% annually according to the power law we explored in chapter 1. Well, gold manages about 10% annual growth, ignoring this year, which is exceptional, at 50%, combining 7% monetary expansion, 1.5% from new mining, and 1.5% from momentum trading. Starting from today's positions, Bitcoin at 2.4 trillion and gold at 24 trillion, we can project these growth rates forward with reasonable confidence. By 2037, following these established patterns, Bitcoin should reach 45 to 50 trillion, while gold grows to 40 to 45 trillion. That's the crossover point, the moment when Bitcoin officially becomes larger than gold. These projections simply extend two well-established trends that have held for years. Should you own gold? Gold will likely maintain its role in jewelry and industrial applications, but not dentistry, while its monetary function continues to evolve. The transition from gold to Bitcoin will take time, as all monetary transitions do, but the direction is unmistakably clear. This evolution requires a shift from physical storage systems to digital verification networks. This fundamental evolution changes not just what we use money for, but how we think about and interact with value itself. Recent crises prove gold's safe haven narrative is false. During COVID, Ukraine, and bank failures, Bitcoin consistently recovered faster. The institutional divide reveals everything. Central banks buy gold following old treaties, while profit-driven corporations, MicroStrategy, Tesla, Square, hold Bitcoin. Major corporations holding gold as a treasury asset, zero. The opportunity cost has been, and that's really important, there are no gold treasury companies. There aren't. And also, there's no company like MSTR. I joke that maybe we need to have gold treasury companies, and that it should trade at gold MNAVs. But nobody's interested in that, right? There's 200 Bitcoin treasury companies. How many gold treasury companies are you aware of?
Gold is probably easier to buy worldwide than Bitcoin right now.
Yeah. But nobody wants to buy a gold treasury company, or you don't see gold companies issuing preferred shares like MicroStrategy. No. The opportunity cost has been substantial and continues widening. In a portfolio optimized for the digital age, the correct allocation to gold is zero. Anyways, that is the gold chapter on Bitcoin 1 million. I hope you enjoyed the
Tomorrow
book.
we'll be reading from chapter 8.
ETF. Okay, so yeah.
But in summary, I think this chapter does a really great job of illustrating some really interesting ideas about Bitcoin. One of the things I was really surprised about researching this chapter was that the gold relationship to money creation did not exist. Meaning there's no correlation. sometimes the money printer during its highest years has has gold going down, even for the next few years afterwards. So it's like maybe it's delayed effect. Then you look at the chart, you're like, wow, it's not even correlated at all, not even in a delayed manner.
Well, it's certainly not growing faster than money supply either. So, as we're going to get into the later chapters, we're going to say what assets can beat M2. And we've seen stocks can beat M2 a little bit, but after taxes, no, you're not going to beat it. Bonds clearly underperform M2. Real estate underperforms M2. And now we have gold. There are periods when it overperforms M2, like this year. But overall, the graph is not great. This is the graph again. This graph shows that it's all over the map. It's all over the map. And if anything, we're too high right now, and we're going to revert back to mean. Gold is not a good investment, especially when you have Bitcoin. Bitcoin is systematically outperforming gold. And you have to zoom out a little bit to see.
There's a reason that people say Bitcoin's a better gold than gold. And it's because of those criteria: scarcity, timeless, ability to trade anywhere. Like Bitcoin's way better at all of those things. So
this book is out in hardback and paperback. It will be out in Audible and Kindle.
We're waiting for the Kindle's out now, but the Audible's coming. And it's funny. I have a funny story about this actually. Is my friend who came to the event who has Bitcoin told me years ago, I don't play those games. I have a wealth advisor. They make my decisions. Today, he sent me a picture this morning. He's reading the book at the cafe at 6 a.m. or whatever. He's like in front of the fireplace at this cafe he goes to reading the book. And he said, I'm meeting with my wealth advisor today. I'm going to talk about Bitcoin. Is there anything you want me to ask her or say to her? And I started thinking, like, maybe we should tell her about how Bitcoin's performed so well. Maybe I should tell her about ask her if she does 60-40 or if she has any bonds. And I decided to go with something different. I said, ask her if she's familiar with the Kelly criteria, just out of curiosity. And tell her that in the book, we discuss Kelly and how it relates to Bitcoin.
Yeah.
And that she should read the book. So this book is a great book for your financial advisor or your financial advisor friends to read because of that Kelly chapter. And of course, because of all the chapters. But the first few chapters in the Kelly, they'll find very interesting, I think. Really
there's a lot of information here that you won't find anywhere else. The quantum chapter, I don't think there really is this in a print publication yet.
No, it's interesting. I was watching another thing today. I was watching this Bitcoin University. I like to follow his stuff.
Oh yeah.
I don't always agree with everything he says, but I really like his content. And he did a great thing about whether we're in a bear market or not, because Nick Szabo said we're in a bear market. And I was really wanting to see charts. They didn't have them on there, but I really wanted to see charts of Bitcoin relative to the S&P and or the S&P and gold priced in Bitcoin to kind of see where that chart looks at historically. Anyways, one of the things he was saying today on there was that, I forgot what I was going to say about him. What were we talking about right now?
Well, we're talking about gold, but you're talking about him. He didn't, I don't know.
I forgot where I was going, but it was a really great his things are really short. If you don't listen to Bitcoin University, I recommend it. It's a really good YouTube channel.
Yeah.
And he's got a lot of valuable stuff on there. I forgot what my exact point is, but I'll tweet it when I remember it.
Yeah. So the Audible should be in a couple of weeks.
Audible should be coming.
We finished all the recording and stuff. Martin Luther King says, no single company is better than real gold. Well, yeah, I don't know, but yeah, real gold is probably better than a gold miner,
Someone says, don't you need physical security for Bitcoin too?
No.
Well, not the way you need it for gold.
Yeah.
Can you go into someone's house and find their Bitcoin?
Pretty hard.
That's gonna be really hard. It's not in a giant stack in their safe.
Yeah.
Or like in a jewelry drawer.
Well.
So, to a degree, you need to have physical security. If you're very public and you have Bitcoin, you're worried about physical,
you do.
Someone coming in and wrench attacking you or whatever. But of course. Yeah.
That's about it for the reading.
I was going to say we'll do another reading tomorrow. Thanks
Yeah.
for tuning in.